Hey guys, it's Sasha. I have been investing in a different index fund for the last few months, and in this video, I will tell you which index fund I am now buying. But more importantly, I want to share the reason why I'm buying this particular index fund and not one of the hundreds of other options out there. And I want to show you some interesting analysis and give you the pros and cons of different options. What's right for me might not be right for you. So maybe I can give you some food for thought to decide for yourself which index fund would be right for you. Now, most of you know me as an active investor, right? That means I buy individual stocks instead of investing in the index in my investing portfolio. I have been an active investor for coming on to 20 years now, and my strategy has done me pretty well so far. But in my pension, in my retirement account, I hold a reasonable chunk in index funds. And the reason is pretty obvious. I understand the risk of investing in individual stocks. I also understand that there is an overwhelming likelihood that over the long term, even though I do it, my active investing will do worse than just investing in the index fund. What I do with my pension is a little bit different to what I do with my day-to-day investing. I am guessing some of you might be in the same boat. You know that investing in an index fund is the right choice, but you go and buy individual stocks anyway. So first up, let's clarify specifically what we're talking about when we talk about index funds, because there's a lot of things out there that are called an index fund, but in reality, they are anything but. And I think those options are a pile of garbage, most of them, sucking money from investors. So here is what I think represents an actual index fund. 1, it needs to be passive, not active. 2, it has to be broad-based, not narrow-based or selective. 3, it needs to be replicating, not synthetic. 4, I want it to be market cap weighted, not some fancy arbitrary gimmick. And it needs to have a low expense ratio. And I want the fund to be relatively large for liquidity and low market spread. Let me quickly explain most of these because some of them are pretty important. If you're investing in an index fund, you want to follow the index that you've selected, more on the specifics later, but you do not want to follow a random fund manager's arbitrary decisions. That is the opposite. The whole reason to invest in an index fund is to eliminate bias, to eliminate some random guy, you or some other random guy, making decisions. In the latest Spiver report, 93% of active equity funds lost to the S&P 500 over the last 20 years. And a couple of years ago, before the tech stocks that everybody is invested in went bananas, that number was more like 95 to 96%. Next, an index fund has to be broad-based. This means that if you buy an index fund of the S&P 500, for example, it better include everything in the S&P 500 or pretty close to everything. The moment that you deviate from this, the index fund stops being a real index fund, in my opinion, and you're just doing active investing under a different name. Sometimes you see index funds that pick a specific sector like tech or healthcare or whatever. Sometimes you see index funds that pick growth or core parts of the overall index. And you've got to begin asking yourself questions like, who is deciding what is growth and what is core? Are there companies out there that don't want to grow, right? And why? Why do some companies get classified as one thing, some companies get classified as another thing? I ignore any selective index fund. I do enough active investing myself as it is. No thank you. Then I only want to buy into replicating index funds and not synthetic ones. A replicating index fund actually goes out and buys the shares of the companies in the index. They actually own those shares. If you look at the list of any major company, you will see as the biggest shareholders, BlackRock, Vanguard, State Street, all of these kind of guys. And the reason is they operate index funds and they buy the shares of those companies because people invest in the index funds. Simple as that. So if you invest in the global stock market index, that index goes and buys shares of the thousands of different companies around the world. A synthetic fund does not do that. It doesn't buy any shares. So when you invest in a synthetic fund, that fund goes and does some weirdly complicated trades using derivatives. I'm not going to go into the depths of that. It just means that they are able to pay out the same return to you that the index would have gotten based on the swaps and etc. that they operate in. The problem is when you buy a synthetic ETF, a synthetic fund, you are adding a whole new layer of risk and unnecessary complexity. And I just don't think there is any good reason for it. The prices on regular, normal, fully replicating funds are very low. The cost is very low. And when you have this new counterparty risk, if something happens to the company that you bought this fund that is synthetic from, you might be in a bit of trouble and there's a risk that you would lose your money. When the fund actually owns the shares of all of those underlying companies, you just don't have that risk. Next, I only buy market-weighted index funds. That means that the companies in the index fund are weighted based on how much the total shares of each company are worth. So at the moment, companies like Microsoft and Apple are worth around $3 trillion. So they each make up 7% of the S&P 500 overall. But American Airlines is only worth $7 billion. So they make up 0.01% of the S&P 500. So when you buy into the S&P 500 index that is properly weighted, a lot of your money is going to be going to those big companies and very little is going to be going to the small companies. Now, recently, some of the biggest companies in the world like Google, Microsoft, Apple, Nvidia, and others have grown much faster than the rest of the stock market, somewhat unusually. And so it has become more popular for investors to buy equal weighted index funds. If you buy an equal weighted index fund of the S&P 500, that means that you buy the exact same dollar amount of each company's shares. So if you invest $100 into the S&P 500 that is equal weighted, you buy 20 cents of Microsoft and you also buy 20 cents of American Airlines, even though Microsoft is actually worth 500 times more than American Airlines. And you can see on this chart that over the last 20 years, the equal weight index has outperformed the S&P 500 overall, maybe why it's also very popular. The equal weight is the yellow line, and it got a return of 11.48%, while the S&P 500 got just 10.29%. The idea is that smaller companies in the index have more room to grow. So if you go and invest a little bit more into them, then maybe they can go and double and triple and so on. It is much easier to grow from being a $6 billion business to being a $12 billion business than going from 3 trillion to 6 trillion. And if you look at this chart, it might look like the equal weight index is a no-brainer. The equal weight S&P 500 index was launched in 2003 at the very bottom of the stock market after the dot-com crash. And small stocks are more volatile when you look at stock market crashes. They go down a lot more, but then they recover, they bounce back more after as well. So you can see that between 2003 and 2008, the equal weight index went up about 30% more than the S&P 500 overall. If you started this chart in 2007, just before the financial crash, and all the lines started at 1 in 2007, then you'd get the exact opposite effect. The S&P 500 overall would look a lot better than the equal weight index. There are two problems that I see with an equal weight index when you consider the long run. One, the index sells off the best performing stocks as they begin performing. So if a company does well and their stock begins climbing, begins going up, then that company starts becoming more than 1/500th of the weight in the S&P 500. So to balance it out, to make sure that every company is equally weighted, you have the same amount of money in each one, the index fund that is equally weighted has to go and sell shares of that company that's doing well. But if this is the start of that company growing, 20%, 30%, 50%, maybe 100%, 500% over a 10 or 20 year period, then the equal weight index will just keep selling the best performing stock over all of this period as it's doing well. The better it does, the more they'll sell to even out the index. And then at the same time, the equal weight index buys the worst performing stocks, which is a bit bizarre. Because if a company is doing badly, then their share price goes down. And then that equal weight fund has to go and buy more of that company to bring it back up to the same level as everybody else. So over the long term, I personally don't like the prospect of an equal weighted index as much. There isn't a huge amount of difference. Some people really over focus on this, but over the last 20 years, it's performed very well. I'm not sure that this is necessarily where it's going to go in the long run. But which index fund should you get? Well, the most popular ones are the S&P 500, which is the 500 largest companies in the United States. Then there's the total US stock market index, which includes all of the small companies as well. And then there's the World Stock Market Index, which buys companies from markets all over the world. You can go and buy an index of a specific country, say the UK. You can have a FTSE 100 index or something like that. Those are, in my opinion, a lot more selective. The US market is, in my opinion, not so selective because it actually comprises the vast majority of the global index as well. Now, on the one hand, The World Stock Market Index is the most comprehensive, right? It is the most broad-based index because it includes companies from all over the world. So right now, US companies are doing very well. But what if over the next decade, Chinese companies start doing well, or European companies, or South American companies, whatever? Investing in the World Index means that you get to have exposure to all of that, so it doesn't really matter which countries are doing well and which ones are not. Just be careful, because not all world index funds are what they say on the tin. Here is the MSCI World Index that is the benchmark for many popular world index funds, especially in Europe. You can see up here that the MSCI World Index captures large and mid-cap companies from 23 developed markets and 1,430 constituents. So while it sounds like you're buying the whole world, you're actually still very selective. You're only investing in 1,430 companies. There are way more than that in just the United States alone. And you're also only investing in 23 countries when there's 200 odd in the world. And you're only investing in the developed market countries. And world index funds also often have slightly higher expense ratios. But what about investing in the United States? In the last 13 years, the United States stock market has outperformed the rest of the world. You can see it on this chart, and this has happened in cycles in the past. The current cycle is 13 years in already, and some people say, well, it's likely to switch back, right? So maybe a world index is better than one that is just the US. Now, I personally don't subscribe to that thesis. And here is why. The stock market in the last 15 years has fundamentally shifted, changed from the stock market of the 70s, the 80s, and the 90s. And not changed in a cyclical kind of way. I don't think that this is a cyclical change. I think this change is actually more likely here to stay. The two things that have changed the world are the internet and the iPhone. So when the internet and the iPhone turned up, everything changed and the stock market changed with it. People don't really talk about it. Companies now earn money globally, whereas before, companies tended to make money mostly in their domestic markets. 30 years ago in 1994, the biggest companies in the S&P 500 included ExxonMobil, a US oil company, Walmart, a US retail company, Raytheon, a US defense company, and so on and so on. Today, all of the biggest companies in the S&P 500 serve the entire world. Microsoft, Apple, Nvidia, Amazon, Google, Facebook, all of these companies operate and earn their money right across the whole world. Not only that, but the most ambitious foreign companies are now choosing to list on the US stock market instead of their domestic markets because there is more investors. There is more potential for raising funds should they need it. It is just a more fluid, it is a better, more advanced market. There was a very big IPO recently. The UK computer chip maker ARM listed on NASDAQ instead of the London Stock Exchange despite being a British company. 30 or 40 years ago, that pretty much never happened. And 30 years ago, the fees for trading on different markets were high. It was expensive. It was difficult. Now with online brokers, buying a stock on the US stock exchange if you are based outside the US is super cheap, super easy. There's just no issues. By the way, I have links to my favorite investing apps in the description. Feel free to go check them out if you're interested. Now, I personally like the US stock market. I see it as the global marketplace for companies now. I see it as where the best companies and most ambitious companies from all over the world come to list. And then what about the S&P 500 versus the total stock market index, right? Well, for a long time, I used to invest in just the S&P 500, and data doesn't lie. The first Standard & Poor's index came out 101 years ago in 1923, and since then, the S&P 500 has got a 10%, an over 10% return on average. But I benchmark my personal active investments against VTI, the total US stock market index, because I often invest in smaller companies that are not in the 500 largest companies in the US. And over the long term, the total stock market index slightly outperforms the S&P 500. But in the last few years, the opposite has happened. Since the 2020 market crash, the S&P 500 has done a lot better than small cap stocks. In fact, while the S&P 500 has recently been hitting all-time highs, the small cap stocks that got destroyed in the 2022 market downturn have still not recovered. The Russell 2000 index of small cap companies is still 8% down compared to 2021. Interest rates are about to start falling, and when that happens, it's going to help small cap stocks a lot more than large caps because of their debt. And I think in the craze for AI and the craze for all this tech recently, for the mega cap stocks, investors have kind of forgotten about the rest of the stock market, which may well reverse at some point. So I personally am choosing to go for the total US stock market index so that I have exposure to all the companies listed in the US, big and small. If you're based in the US, that fund is VTI. Very easy. Go and pick that if that's what you want to do. In the UK and Europe, we've had a bit of a problem. There wasn't any real option, but there is one equivalent fund to VTI. It's super hard to find, but it's called the US Equity Index Fund, and you can get the accumulation version with Vanguard UK. Remember, you can now open and pay into multiple different ISAs in the UK starting from this year. So you can go and open a Vanguard ISA just to buy this fund if you wanted to, because it's not available on other platforms. And then you can also have your Interactive Brokers ISA for, say, investing in US stocks like I do if you want to do that. That is my main investing platform. And you can also then help yourself, I don't know, a free share with Trading 212 while you're at it if you want to just check out the platform and see what you think. This US Equity Index Fund is the accumulating version, and that means that dividends get automatically reinvested back into the fund instead of landing as cash in your account. So you don't have to remember to go and reinvest it manually, which is handy, but also remember that this total US index is mostly made up of the S&P 500 anyway. The other companies are only a small slither at the bottom. So the reality is that the two are going to be pretty similar, and you can go and buy the S&P 500 ETF on pretty much any investing app very easily and very cheaply. So there you go. I hope that helps you with making your choice, and I'll see you later.